Welcome back to another broader economic video. Today we're going to be talking about the Fed's recent decision to hold interest rates steady, as there were large expectations that is what they were going to do. I want to talk a little bit about why they held interest rates steady and a few of the data points that they are looking at to determine if rate cuts will occur in the future. If you're new to the channel, my name's Ian Phillips. I'm a realtor in Orange County, and I love talking about the housing market, economic impacts of the housing market, and I do a multitude of videos, some specific housing market, real estate related videos, as well as more broader economic videos. Today is a more broader economic video. So the Fed decides to hold interest rates steady. By the way, there was a 97% chance that the Fed was going to do that, so it wasn't really much of a surprise. The 10-year Treasury yield, which can often have fluctuations based on the Fed's decision to cut rates, raise rates, or hold rates steady, did absolutely nothing today because it was largely in line with expectations. If you're unaware, the 10-year Treasury is basically what determines mortgage rates. Mortgage rates track the 10-year Treasury. So if the 10-year Treasury yield increases, mortgage rates tend to increase either the same day or the next day. And economic data impacts the 10-year Treasury, which in turn impacts mortgage rates. So the Fed, being in line with expectations, didn't do anything to either of those factors. So basically, the Fed said today, at the time I'm recording, that the economy is in a pretty strong position. They're claiming that the job market's steady, unemployment is relatively low, inflation is basically getting close to their target, so they're not going to cut rates and they're not going to raise rates. Now, there's been a lot of talk of potentially tariffs causing another surge in inflation. In fact, I think it was a year ago, expectations for inflation this time in 2026 were going to be between 6 and 7%. Obviously, we haven't seen that. A lot of economists anticipated that tariffs were also going to cause another rise in inflation. Could we see it in 2026? Absolutely. Anything's on the table. We all know sometimes tariffs are added at 100%. Sometimes they're taken away. Decisions change on a weekly basis in this country. But as of right now, tariffs have not impacted producer inflation, neither have they impacted consumer inflation, which is very important. It's what the Fed monitors. People were thinking producer inflation was going to skyrocket, which is essentially what companies pay for products to be delivered into the country. And as a result, consumers were going to be paying significantly more for products that are brought into the country. But producer inflation hasn't really changed. In fact, one of the months in 2025, it actually went negative, which was a pretty big surprise to everyone. But those are good signs if you want interest rate cuts happening this year. So the Federal Reserve voted to take a break from their recent run of interest rate cuts. They cut rates 3 times in 2025, and they're basically navigating questions about what's happening in the economy, largely looking at unemployment, inflation, as well as the chairman of the Federal Reserve is going to be replaced in just a few months here. I don't know the exact date. I think it's May or June that Jerome Powell is going to be replaced by a new Fed. More than likely, it's going to be someone Trump puts in, and he's basically going to cut rates. More than likely. That is consensus right now. So that's a good sign in the second half of this year that we could get lower interest rates and potentially lower mortgage rates. Remember, if the Fed cuts rates when economic data is still very strong, then mortgage rates can actually go up sometimes. Leading up to the election in 2024, Jerome Powell cut rates by a full percentage point, and mortgage rates went from 6% to 7% during the same period of time. So interest rate cuts don't always correlate to mortgage rates changing at the same pace. Sometimes mortgage rates do the opposite. If economic data is not really confirming that the Fed should have cut interest rates or should have raised interest rates in the same situation. So if we see what the Fed members said, available indicators suggest that economic activity has been expanding at a solid pace. Job gains have remained low, and unemployment rate has shown signs of stabilization. So if we take a look, and they also say inflation remains somewhat elevated, but remember their target inflation rate actually was raised from 2% to 2.5% in 2024. And we'll take a look at what inflation is now and what unemployment is doing as well. Here's a chart of the Fed cutting rates. You can see in September 2024 that they did a large 50 basis point cut, and then they cut rates a couple more times in the last few months of 2024. So first we'll take a look at inflation, and obviously we're way below the peak that we saw in 2022 at 9.1%, and inflation has been on a pretty steady decline over the last 2 to 3 years. You can see in September of 2023 we were at 3.7%, and we've kind of done these dips, rise up, everyone's scared that inflation's going to come back, and then it dips again, increases, and everyone's like, oh my god, inflation's coming back. It dips to 2.4, goes up to 3, and now we're at 2.7. So inflation has been on a downtrend overall, but has been on a choppy downtrend, which is normal. You wouldn't really anticipate something like this to continue happening, especially because this was such a large decline. This was when the Fed raised rates the most aggressively they've ever done in history. No surprise that inflation got under control relatively quickly. Now, do keep in mind that just because inflation is down doesn't mean goods are getting cheaper. We are seeing deflation in some aspects of housing. Rents have actually experienced deflation, and real estate, home values have also experienced deflation in a lot of the country, and that contributes to a large percentage of the inflation number. But just because inflation is down doesn't mean goods and services are down. Inflation just means the rate at which something is changing. So we still have positive inflation. Things are still getting more expensive, just at a slower, more normal pace. You can see pre-pandemic, we were sort of averaging around 2%, kind of bouncing between 1.5 and 2.5%. Very, very normal. It's kind of what you want in the economy. You want some inflation. Otherwise, you get something like the financial crisis where you actually had deflation. And that's even worse than inflation, because it means demand has fallen off a cliff. Companies aren't making money. They need to slash prices just to stay above water. And that's when you get bankruptcies, large unemployment, and so on and so forth. So inflation is sort of giving a positive number for the interest rate cutting decision that we could have over the next 2 to 3 months. I'll talk a little bit about my expectation for interest rate cuts this year, where I think unemployment's going, and where I think mortgage rates are going as well. And if we look at unemployment, which again is another major factor that the Fed looks at to determine if they're going to cut rates, we can see unemployment has been on a steady increase. It's going from its low of 3.4% in 2023 to now at 4.4% at the time I'm making this video. We should be getting another set of economic data in the near future here. I'll probably make another video about it when we do get those numbers. But inflation has been on a steady increase over the last couple of years, as inflation has been on a steady decrease. Now, my expectation with unemployment is that it's likely going to continue trending higher. 4.4% is still a historically low number. The average over going back the last 50 years is between 5.6% on the low end and 5.8% on the high end. So 4.4 is very, very low. You're likely going to see it trend closer to that 5.5%, 5.6%, at least in my opinion. We're still seeing a lot of layoffs. We're not really seeing that many job openings. If you have a job, more than likely, the chances are that you're going to have security in that job. But if you're looking for a job, it's very unlikely that you are going to find one unless you have an enormous amount of experience. We're not really seeing that many job openings, unfortunately. I'm speaking to a lot of people who have actually been laid off over the last year, and they are struggling to find a job. They've applied for hundreds of jobs with tons of experience, and a lot of the time the job openings are not legitimate. Companies just put them there to show that they are hiring and expanding, but in the reality they're not actually hiring for certain positions. Now, you do have a lot of tech startups as well. Here where I live in Orange County, a lot of companies have actually moved their headquarters here, and they are hiring. They are hiring for software developers, engineers, marketing agencies. A lot of those companies are hiring, but they're not hiring thousands of people. They're hiring 2 people here, 5 people here, and they're sifting through hundreds of applications. So obviously there are some companies hiring, but the scenario that is more popular right now is layoffs. We saw, I think it was 1.2 million layoffs in 2025, and the CEOs were actually surveyed asking why they laid off so many people, and they gave 3 scenarios. One was tariffs, one was AI, and one was corporate restructuring, which could really mean anything. The least likely cause for layoffs was tariffs. Second least likely was AI. I think tariffs was like 6,000 CEOs said were laid off. 6,000 people were laid off due to tariffs. At least that's what the business owners said. And then I think it was 45,000 were laid off due to AI. And then 1.1 million were laid off due to corporate restructuring, which could mean a multitude of things. More likely than not, it's companies that were bought out and they're kind of just laying those people off that came with that company as they try to increase the basically the balance sheet. They want to raise the profit and decrease the cost. They want to raise the revenue, decrease the cost, in turn increasing profit. And the easiest way to do that is to lay people off in unnecessary positions. So that was a lot of the reason for layoffs in 2025. I would expect that to continue happening in 2026. We're going to get a bunch of corporate big tech earnings over the next week. I think there's a lot of companies reported earnings today, actually, at the time I'm making this video. And they're likely going to announce more layoffs happening in 2025. But unemployment is a key factor that the Fed monitors when deciding if they're going to cut interest rates. And my personal opinion, based on historic data, once this starts increasing, it usually increases for a significant period of time. So that would be my expectation. This continues increasing. Inflation is a little bit unknown for me personally. I would anticipate that if unemployment is increasing, that means less people have jobs, less people are earning money, less people are spending money. I would think that a decrease in demand would also cause a decrease of inflation. Obviously, tariffs will be the unknown factor with that. We have yet to see tariffs cause consumer inflation. It could happen in 2026. It's just not something that is showing up in the data quite yet. So if we have this scenario where unemployment is going up, inflation either stays the same or trends down a little closer to 2%, then I think the Fed will likely cut rates multiple times in 2026. Now, I do believe over the next 2 to 3 Fed meetings, they're probably going to hold rates steady where they are right now. I don't think they're going to raise. I don't think they're going to cut. I think they're just going to continue to see. We're monitoring the data. We want to see if inflation is going up. We want to see if unemployment is going to go down, stay steady, or increase. Because, again, at the end of the day, the Fed is also a slave to the data. They don't know what's going to happen 2-3 months from now, and they don't want to make the mistake of cutting interest rates too soon and sort of giving that surge to inflation that a lot of people are scared of, but they also don't want to cut rates too late, and then we see the unemployment rate increasing. Obviously, I don't think something like this is going to happen where we get 10% unemployment. The financial crisis is sort of not necessarily something that was caused due to interest rates. It was a lot of borrowing money lending money to people who shouldn't have been getting that money in the first place. They weren't qualified. And now we have much stricter regulations on lending money. But I do want to briefly look at the Fed rate monitoring tool, which is going to tell us what the odds of rate cuts are for this year. And historically, this has been pretty accurate. So their next meeting is in March. Obviously, The meeting in January, they didn't raise rates. Next meeting is in March, and consensus is with an 89% chance that the Fed is not going to raise rates in their next meeting. 11% chance that they cut rates. This is what the Fed's interest rate is at right now. If we look at April, there is a 75% chance that they are again not going to cut rates, and a 24% chance that they will cut rates. If we look at June, this is sort of when you get closer to the odds that the Fed cut rates. So what did I say? I said the next 2 to 3 meetings, they're probably going to hold rates steady. So that's March, April, June. So this would be 2 meetings where they hold rates steady. And third meeting, obviously still up in the air. It's going to be data dependent. But as of right now, it is only a 40% chance that the Fed holds rates steady, and obviously a 60% chance that the Fed is going to do some sort of rate cut. Interestingly, 11% chance they do a double rate cut of 50 basis points. So June could potentially be that time frame where we get another rate cut. In July, there's a 73% chance that the Fed is going to lower rates below where they are now. So almost a guarantee that we get a rate cut at least by July, but a high likelihood that we have our first rate cut of 2026 by June. Now, interestingly, that sort of coincides to when the chairman of the Federal Reserve is going to be replaced. So maybe that's why investors are currently betting that June is when the first interest rate cut will be. Obviously, we'll have to wait and see what happens, but that's kind of my expectation going into 2026. I do think we will have lower mortgage rates. We briefly touched below 6% a few days ago, I think about a week ago, when Trump announced they were buying $200 billion in treasuries. That lowered mortgage rates pretty drastically in a single day. If I had to guess where mortgage rates were going to be by the end of 2026, I would say probably 5.5%. Now, unless we get a economic scare where we see unemployment rising pretty quickly, inflation dropping very quickly as well, then maybe we get even lower mortgage rates. But as of right now, I'm also just dependent on what's happening with the data, and I'm just seeing a trend of inflation going down and unemployment going up, and I don't see that changing in 2026. We have oil that has dropped 25% in just the last year, and that obviously is going to impact consumer inflation because almost everything we consumed is brought in on a cargo ship from overseas, and if their cost to deliver is 25% less because of fuel dropping substantially, then there's a lower likelihood that we are going to be paying more for those products coming in. But again, the caveat is tariffs. We haven't seen that show up in consumer inflation just yet. But that's kind of my expectation for 2026, and also what happened with the interest rate cutting decision that was made in the first week of January. If you like this video, subscribe for more. If you're looking for a realtor in Orange County, reach out. I'd love to chat. You can check out my website in the description below. I'll see you next time.